The agenda is as follows: the introductions, then sector analysis and outlook, panel discussion, and Q&A.
We have Jonathan Wallis, who is Development Director at Tritax Symmetry, Adrienne Howells, Development Director at GLP. Next up, we've got Justin Stead, who is currently the Chief Executive of Radley Handbags and Accessories and advisor to Desmond & Dempsey luxury pyjama brand.
So we expect the UK economy to experience a steeper recovery all the way to 2021, where we could potentially get to the pre-pandemic peak. If that wasn't to happen, we expect to get close to full employment all the way in the middle of 2022. You see that the overall share of online sales actually, the volume spend actually increased by 54% when compared to February 2020.
You've had DHL take quite a lot of space, XPO, we've mentioned DSG already. Amazon, of course, have taken space. There is a bit of a trend on this chart. If you look at, I suppose, the Amazon factor, as it were, who have been advised by Mr. Milner across all of these deals. If you look at it from 2014, they took about 12% of the market, and it was a record year. In 2016, sort of circa 16%, 18, circa 20%, and then in 2020, we think it's going to account for 30%. That said, if you do take them away from this chart, it's still very positive figures, and it's still well in line with the 10-year average in excess of 25 million square feet, which I think shows the diversity and strength of the market overall.
The industrial sector, we see a new record year take-up this year, that is certain. In terms of investment activity, we expect investment volumes to pick up and potentially further yield compression, namely on single-let distribution warehouses in prime location.
First is that we've got to start building again. And during lockdown, it's interesting to see those figures on speculative buildings. We have let 80% of our speculative builds during lockdown. We've only got one building left. That's 160,000 square foot out of the entire 33.4 million square foot portfolio. So that's not a bad void ratio, but it does also highlight the issue that's out there in the sector, and that building's got a number of names against it at the moment. So I think it's more of a structural issue. There are oven-ready sites that we can get onto and start building, and we've got our next phase of speculative developments in the pipeline and sort of on the starting blocks. But I think we've got to go back to the more structural issues with the system, and in particular the planning system, our approach to highways, our approach to utilities, our approach to the skills gap. And those are four areas where fundamentally we need the system to change if we're to get stock into the market quicker. Because at the moment, I think if take-up continues as we foresee it to, we're in for a long period of supply shortage. And some of those regions, the Northwest that you've named, for example, we're already at that stage.
And there's really three segments to it, really blunt trauma of what we've worked through, the consolidation period where we are now, and a return to a new world of growth, which we see is starting probably next summer. So we've taken this opportunity to absolutely reshape all parts of our business, whether that be brick and mortar, whether I don't see the death of brick and mortar, but the traditional structures and setup and approach has been shaken to its absolute core. And that's going to continue for the foreseeable future, particularly short term. Needless to say, digital has grown in a very exciting manner, which creates all sorts of opportunities, both direct to consumer and through digital partners and platforms. And then that has a knock-on effect in terms of warehousing, DC operations, logistics, and the all-important and progressive outlook in terms of operations, in terms of dropship, and not just here in the UK, globally.
In terms of the supermarkets, I don't know if they are structurally currently set up for that growth long term. They have actively, come across this blip, and they've responded to it by probably putting a lot of staff in place. But whether that's a long-term way of continuing, I don't know. And I think that potentially their infrastructure will have to change to accommodate that big growth of online demand in the grocery sector. When you look at the type of people that are now shopping for their groceries online, a lot of the older generations that wouldn't have currently considered it previously have adapted really well, and a number of them don't intend to go back to their previous shopping habits. And maybe we see some parallels to kind of 2008, around that time, where shopping habits for grocery fundamentally shifted from your kind of weekly big shop to shopping more smartly and going to different places. And those disruptors, the discount retailers, took advantage of that. And other retailers had to adapt and spend a lot of time over the years adapting to those fundamental shifts. And maybe we're seeing some parallels again.
Clearly, there's a wide gap between yields in the industrial and logistics sector compared with all asset classes in retail, other than food stores, which is just completely continuing to polarize, to be honest. Retail yields across warehousing, shopping centres and high streets are being offered at softer yields that we've never seen before in this market. So it's a really interesting time. Demand seems to be in retail for two different categories, either the long income, perceived dry, food store type, or to a certain extent DIY as well. We've seen some institutions like Hermes and Aberdeen acquire B&Qs recently. And then you've got the second category, which is demand for retail to repurpose it and take it away either in whole or in parts and reposition it as something else. Recently we've seen housing associations buying shopping centres to do that, and other major city centre sites which typically form retail but probably need to be reduced by quite a distance to make them competitive again. I think as it continues, as industrial gets more and more competitive and crowded, I think there will be more and more risk-averse investors who do look at retail and think, now these yields are at this level, is this now attractive enough for us to enter as a counter-cyclical play? I think the key will be understanding each retailer and also the ERVs, and I think ultimately that will end up driving those interested parties towards the more prime assets, but we can certainly see a bit of a theme happening there. One of the key elements though of that will be when the debt market's ready to get back into retail, which it isn't yet.